There's a quiet truth that most Americans never learn. The wealthy do not pay lower tax rates because they break the law. They pay lower effective tax rates because they understand a section of the Internal Revenue Code that most working people have never read, never been taught, and never been told exists. Today, I'm going to walk you through 10 completely legal, fully documented tax strategies that the wealthy use every year. These strategies are not gray areas. They are not aggressive interpretations. They are not loopholes. They are explicit provisions written into the United States tax code by Congress. They have IRS code section numbers. They have official IRS guidance. They have decades of court precedent. If you implement even 3 of the 10 strategies I'm about to show you, you could legally save between $5,000 and $50,000 in taxes this year, depending on your income. Over a working lifetime, the math is staggering. Most middle-class Americans will pay several $100,000 more in taxes than they legally need to, simply because no one ever taught them these strategies. Today, you learn them. Before we begin, you need to understand the foundational principle. The U.S. tax code is not designed to be fair or equal. It is designed to incentivize specific behaviors that Congress wants to encourage. The tax code rewards retirement savings. It rewards homeownership. It rewards charitable giving. It rewards entrepreneurship. It rewards capital investment in real estate and businesses. It does not reward earning a paycheck, paying rent, and buying consumer goods. The wealthy understand this. They structure their entire financial lives around the behaviors the tax code rewards. The middle class, by contrast, often earns their entire income through paychecks, the most heavily taxed form of income in America. Today's 10 strategies will teach you how to shift more of your income into categories that Congress has chosen to reward. Every strategy I'm about to share comes with a specific IRC section number you can reference. This means when your CPA or tax preparer questions it, you can point them to the exact statutory authority. None of this is hidden. It's all written down. Most people just never look. Strategy 1. Maximize your tax-advantaged retirement accounts. This is the foundational strategy. It is also the most underutilized. The IRS allows you to contribute pre-tax dollars to a 401k, traditional IRA, and other qualified retirement plans, which directly reduces your taxable income for the year. For 2026, under IRC Section 402G, the elective deferral limit for 401k, 403b, and most 457 plans is $24,500. If you are age 50 or older, IRC Section 414(vi) allows an additional catch-up contribution of $8,000, bringing your total to $32,500. Under Secure 2.0, employees age 60 through 63 get an enhanced catch-up of $11,250 instead of $8,000. For traditional IRAs under IRC Section 408, the 2026 limit is $7,500 with an additional $1,100 catch-up if you are 50 or older. Now do the math. A married couple, both age 55, both contributing the maximum, can shelter $93,200 from current income tax. At a 32% marginal rate, that is approximately $29,800 in tax savings in a single year. Strategy 2. The Backdoor Roth IRA. Most high earners cannot contribute directly to a Roth IRA. For 2026, the Roth IRA contribution phase-out begins at $153,000 for single filers and $242,000 for married filing jointly. Above these income levels, direct Roth contributions phase out completely. But there is a fully legal workaround. The Backdoor Roth IRA strategy involves 2 steps. First, you contribute up to $7,500 to a traditional, non-deductible IRA. There is no income limit on traditional IRA contributions under IRC Section 408. Second, you immediately convert that traditional IRA balance to a Roth IRA under IRC Section 408A. Because the contribution was non-deductible, the conversion is generally tax-free. The result You have legally moved $7,500 into a Roth IRA, despite earning over the direct contribution limit. There is a critical trap to avoid here called the pro rata rule. If you have any other traditional IRA balances with pre-tax money, a portion of your conversion will be taxable. The fix is to roll all pre-tax IRA balances into your 401k first, leaving only the non-deductible contribution to convert. Strategy 3. The Mega Backdoor Roth. If the Backdoor Roth is the legal workaround for high earners to access $7,500 of Roth space per year, the Mega Backdoor Roth is the workaround that unlocks up to $47,500 per year. This is, dollar for dollar, the single most powerful tax-advantage savings strategy available to W-2 employees in America. Here is how it works. IRC Section 415C sets a total contribution limit for all sources combined into a 401k. For 2026, that limit is $72,000 under age 50, $80,000 for ages 50 and up, and $83,250 for ages 60 through 63. This is the cap for all money going into the plan from any source. Your contributions, employer match, and after-tax contributions. After you max your standard pre-tax contribution of $24,500 and assuming a reasonable employer match, there's often $40,000 or more of remaining space under the Section 415C cap. The Mega Backdoor Roth strategy uses this remaining space for after-tax contributions, then immediately converts those after-tax dollars to Roth status, either through an in-plan Roth conversion or an in-service distribution to a Roth IRA. The result, you have legally moved up to $47,500 per year into Roth status. Tax-free growth, tax-free withdrawals, no income limits. The catch, your employer's 401k plan must permit after-tax contributions and either in-plan Roth conversions or in-service distributions. Not all plans do. If yours does, this strategy alone can build millions in tax-free retirement wealth over a career. Strategy 4. The HSA as a stealth retirement account. The health savings account governed by IRC Section 223 is the most tax-advantaged account in the entire U.S. tax code. It is the only account that offers what is called a triple tax advantage. First, your contributions are tax-deductible from current income. Second, the money grows tax-free inside the account. Third, withdrawals are completely tax-free if used for qualified medical expenses. No other account in America gives you all three. For 2026, HSA contribution limits are $4,400 for self-only coverage and $8,750 for family coverage. If you are age 55 or older, you can contribute an additional $1,000 as a catch-up. To be eligible, you must be enrolled in a qualifying high-deductible health plan and have no other disqualifying coverage. Here is the stealth retirement trick that most people miss. After age 65, HSA withdrawals for non-medical purposes are treated like a traditional IRA withdrawal, taxed as ordinary income but with no penalty. This means an HSA functionally becomes a third retirement account, on top of your 401k and IRA, with even better tax treatment if used for medical expenses, which the average retiree will have in significant amounts. The optimal strategy: maximize your HSA contributions, pay current medical expenses out of pocket if you can, save all receipts, and let the HSA balance grow invested for decades. You can reimburse yourself for those old medical expenses at any time in the future, tax-free. Strategy 5. Tax loss harvesting. This strategy applies to anyone with a taxable brokerage account. Under IRC Section 12111B, you can use realized capital losses to offset capital gains, and if your losses exceed your gains, you can deduct up to $3,000 per year against ordinary income. Any excess losses carry forward indefinitely to future years. Here is how the strategy works. At any point during the year, particularly in December, you review your taxable investment portfolio. Any position currently showing a loss can be sold to realize that loss for tax purposes. The realized loss offsets capital gains you may have taken elsewhere, perhaps from rebalancing, perhaps from selling a winning position. If your losses exceed your gains for the year, the first $3,000 of excess loss reduces your ordinary income. For someone in the 32% tax bracket, that is nearly $1,000 in tax savings from a single move. There is one critical rule to follow, called the wash sale rule under IRC Section 1091. You cannot repurchase the same or substantially identical security within 30 days of selling it, a loss, or the IRS disallows the loss deduction. The legal workaround: sell the losing position, immediately buy a similar but not identical alternative. For example, sell one S&P 500 fund and immediately buy a different S&P 500 fund from a different provider. Or buy a total market fund instead. Your market exposure stays nearly identical, but you have legally captured the tax loss. Strategy 6. Donor-advised funds and the bunching strategy. Under IRC Section 170, charitable contributions to qualifying public charities are tax-deductible if you itemize. For 2026, the One Big Beautiful Bill Act introduces an important change. Charitable deductions now have a 0.5% floor of adjusted gross income before deductions begin to count. This means you must contribute at least 0.5% of AGI before any of the contribution becomes deductible. This new floor makes the bunching strategy more powerful than ever. Here is how it works. Instead of giving small amounts to charity every year, you bunch multiple years of charitable contributions into a single tax year. Then, take the standard deduction in the off years. A donor-advised fund, or DAF, is the perfect tool for this. You contribute a large sum to the DAF in a single year, say $50,000 representing 5 years of intended giving, and immediately receive the full tax deduction for that $50,000. The DAF then holds the money and allows you to recommend grants to your chosen charities over the following years on your schedule. For a high-income earner in the 35% tax bracket, bunching $50,000 of charitable contributions into one tax year can save approximately $15,000 to $17,000 in federal taxes versus spreading it across 5 years. There is one important restriction. Under the new 2026 rules, the above-the-line charitable deduction of $1,000 for single filers and $2,000 for married filing jointly cannot be used for DAF contributions. The DAF deduction requires itemizing. Strategy 7. Qualified charitable distributions, available at age 70 and a half. Under IRC Section 408D-8, if you are age 70 and a half or older, you can transfer up to $111,000 directly from your traditional IRA to a qualified charity in 2026. This is called a Qualified Charitable Distribution, or QCD. Here is why this is one of the most powerful tax strategies available to retirees. A QCD has 3 specific advantages over a normal charitable contribution. First, the amount donated is excluded from your adjusted gross income entirely. It does not become income, then a deduction. It is simply never income to begin with. This is more powerful than a deduction because it reduces your AGI, which can have ripple effects on Medicare premiums, Social Security taxation, and the new charitable deduction floor we just discussed. Second, a QCD can satisfy your required minimum distribution. If you are 73 or older and required to take distributions from your IRA, sending those distributions directly to charity as a QCD removes the entire amount from taxable income while satisfying your RMD obligation. Third, you can use a QCD whether you itemize or take the standard deduction. Unlike a standard charitable deduction, a QCD works for everyone. The one important note: QCDs cannot be sent to donor-advised funds or private foundations. They must go directly to operating public charities. Strategy 8. The Qualified Business Income Deduction, also known as the QBI or Section 199A deduction. Under IRC Section 199A, if you own a qualifying pass-through business, a sole proprietorship, partnership, S-corporation, or LLC taxed as one of these, you may be entitled to deduct up to 20% of your qualified business income from your federal taxable income. This deduction was created by the Tax Cuts and Jobs Act in 2017 and was made permanent under the One Big Beautiful Bill Act in 2025. For 2026, this 20% deduction can mean tens of thousands of dollars in tax savings for business owners. There is one complication for high earners. For service-based businesses like consultants, attorneys, doctors, accountants, and financial advisors, the deduction phases out at higher income levels. For non-service businesses, the deduction can continue at higher incomes but is subject to wage and asset limitations. The advanced strategy here is the S-corporation election. If you own a profitable business making $150,000 or more in net profit, electing S-corp status under IRC Section 1361 allows you to split your income between W-2 wages and shareholder distributions. The shareholder distributions are not subject to self-employment tax, saving you up to 15.3% on that portion. Done correctly, the QBI deduction combined with the S-corp election can save a successful business owner $20,000 to $40,000 per year. Strategy 9. Real estate depreciation and cost segregation. This strategy applies to anyone who owns income-producing real estate. Under IRC Section 167 and 168, the IRS allows you to depreciate the cost of investment property over a specific recovery period, 27.5 years for residential rental property, 39 years for commercial. Depreciation is a non-cash expense that reduces your taxable rental income, often dramatically. Here is the simple version. Imagine you own a rental property worth $400,000, with $300,000 of that value attributable to the building itself, excluding land. The annual depreciation is approximately $10,900 per year for residential rental. This $10,900 is a paper expense. You don't actually spend it, but it reduces your taxable rental income by that amount. For a property generating $15,000 in net rental income, depreciation alone often eliminates the entire tax liability on that income. The advanced strategy is cost segregation. By having a cost segregation study performed on your property, you can identify components that depreciate faster than the building itself, things like flooring, fixtures, appliances, landscaping, and depreciate them over 5, 7, or 15 years instead of 27.5. This can accelerate depreciation dramatically in the early years of ownership, sometimes producing tens of thousands of dollars in additional first-year deductions. Real estate also offers the 1031 exchange under IRC Section 1031, which allows you to defer all capital gains tax when selling one investment property and buying another. This means wealthy real estate investors can build entire portfolios over decades without ever paying capital gains tax. Strategy 10. 529. Plan superfunding and estate planning. Under IRC Section 529, 529 college savings plans allow tax-free growth and tax-free withdrawals for qualified education expenses. But there is an extraordinary estate planning benefit most people never learn. Under IRC Section 529C, 2B, you are allowed to front-load 5 years of annual gift exclusion contributions into a single year, called superfunding. For 2026, the annual gift exclusion is $19,000 per recipient. This means a single grandparent can contribute up to $95,000 to a grandchild's 529 plan in a single year, treating it for gift tax purposes as if it were spread across 5 years. A married couple can contribute up to $190,000 per grandchild in a single year. Here is why this is so powerful. The money is immediately removed from your taxable estate. Under current law, the federal estate tax exemption is $15 million per person, or $30 million per married couple. But these exemptions could change. Removing assets from your estate while you are alive is a permanent gift tax planning move. Meanwhile, the contributed money grows tax-free inside the 529 for the grandchild's eventual education. If the grandchild does not need all the money for education, recent Secure 2.0 provisions allow up to $35,000 to be rolled into a Roth IRA for the beneficiary, subject to specific rules. For grandparents looking to make a significant tax-efficient impact on their grandchildren's futures, this is among the most powerful provisions in the entire tax code. Let me bring it all together. The 10 strategies I've just walked you through are not exotic. They are not loopholes. They are not aggressive. Each one has a specific Internal Revenue Code section, official IRS guidance, and decades of legal precedent supporting it. Together, they represent the actual playbook the wealthy use to legally minimize their tax burden every year. Most middle-class Americans use one of these strategies, sometimes two. They contribute something to their 401k. Maybe they have an HSA. The wealthy use 7, 8, or all 10, stacking the strategies on top of each other for compounding savings. Let me give you a final example. A married couple, both age 55, both earning $200,000 with one operating a small business as an S-corp. By implementing all 10 strategies, maxing retirement accounts, backdoor and mega backdoor Roths, HSA optimization, tax loss harvesting, DAF bunching, QBI optimization, through the S-corp election, and so on, this couple can legally save between $60,000 and $90,000 in federal taxes in a single year. Over 20 years of working, that is potentially $1 to $2 million in tax savings, which then compounds in tax-advantaged accounts to a vastly larger retirement balance. This is not theoretical. This is how the wealthy actually do it. They simply know what the tax code rewards, and they structure their lives to take advantage of every provision Congress wrote specifically to be used. Here's what I want you to do this week. First, take an honest inventory. Of the 10 strategies I just walked you through, how many are you currently using? Most people, even relatively financially literate ones, are using 2 or 3. Identify the gap. Second, prioritize. Not every strategy applies to every person. Real estate depreciation requires owning rental property. The QBI deduction requires business income. QCDs require being age 70 and a half, but several strategies apply to almost everyone. Maximizing retirement contributions, using an HSA if eligible, tax loss harvesting in taxable accounts. Start there. Third, get qualified help where it matters. The simpler strategies, maxing a 401k, opening an HSA, you can implement yourself. The more advanced strategies, mega backdoor Roth conversions, S-corp elections, cost segregation studies, donor-advised fund strategies, almost always benefit from working with a competent tax professional. The fee you pay a good CPA is typically a fraction of the taxes they save you. A final, critical caveat: I'm not a licensed tax professional, and nothing in this video is personalized tax advice. Tax laws change. Individual situations vary. Always verify the current rules and consult with a qualified tax advisor before implementing any of these strategies. With that said, the strategies themselves are real. The IRC sections I cite exist. The savings are calculable. The wealthy use them year after year to legally keep more of what they earn. The only thing standing between you and those same savings is knowing they exist and being willing to do the work. Now you know they exist. The choice is yours. Choose carefully. Your future self is watching.